$4.7 trillion.
And if you find great deals, you will sell them.
You don't have as many options.
You just got to find it.
Let's go ahead and dive into the first article of the day, which is one that I pulled up. Samsung is reportedly going to be receiving $6 billion from the CHIPS Act for U.S. expansion. So if you guys aren't familiar with the CHIPS Act, it's a piece of legislation that was submitted by the Biden administration that tried to incentivize chip manufacturing in the United States. Historically, we've had a lot of our chips being manufactured outside the United States, particularly in areas like Taiwan and other countries closer to China and some other countries as well that over the last, call it decade or 2 decades, we've had deteriorating relationships with. So obviously they want to make sure that they incentivize these manufacturers to come onshore, because obviously it's a benefit for national security and obviously from an economic standpoint as well. So it talked a little bit about, the grants that they're going to be shelling out. I guess in total, $28 billion in grants will be issued in this first wave, of which Samsung will receive $6 billion. And then there's some other companies involved like Taiwan Semiconductors and Micron Technology, et cetera, Intel, that are also in that core group. So the reason why it's significant, and in particular for commercial real estate, is because this investment is going to go into actually creating manufacturing facilities domestically. So they've already, I guess Samsung's already created or developed a $17 billion, 7 million square foot manufacturing facility in Taylor, Texas, which they selected back in 2021. I would imagine that they're probably just going to continue to increase their footprint in and around that market, if I had to guess, or maybe they decide to go, somewhere else in Texas. But apparently in 2022, Samsung proposed investing roughly $200 billion in the U.S. over the next 20 years. It's on 11 chip-making plants in Texas. So it just kind of further showcases that these companies are going to be having massive impacts in these areas. And obviously, that's going to proliferate into other parts of the economy. So I thought it'd be kind of interesting to share this article.
If you can find like 1 or 2 specific buyers anywhere in the country, right, that are just, I'm not saying you're going to reach out to Samsung right now and go all of a sudden be the Samsung broker, but I am saying be the person who can source stuff for the right buyers who are buying stuff and they're motivated to buy stuff, right? So this just gave me the idea. It's like, I got to reach out to 2 people, 2 friends of mine, one who's actually based in Texas and one friend who buys a lot in Ohio. And I'm like, instead of just prospecting where I know, like in my backyard, why am I not prospecting for people who are buying like 5, 10, 20 deals a year and buying some substantially larger deals, especially stuff like this, right? Like imagine if you were able to pinpoint, obviously, because it's all freaking public information, where Samsung's location is, their 7 million square foot plant is right now, their manufacturing plant. Imagine if you could try to lock up all the real estate around it. There's just so much opportunity there. Right. And it's just thinking a little bit differently. I think will give people a lot more opportunity.
That's exactly right. So the path of progress, which we've talked about multiple times on this podcast, is that, these dollars are going to proliferate outside into other sectors of the economy. So if you can find real estate in that area that, you can capitalize on because maybe the owner doesn't have the same information you do, or, you're able to even get it under contract, even if it's somewhat closer to market, but there's other plays you can make to then leverage into other opportunities. Again, it just kind of reinforces the fact that you need to keep up to date on all this information. And then that's why we do this live stream, is to try to keep you guys informed on all the things that are coming available. So yeah, it's kind of crazy, man. Like, and again, I think that's, when you talk about government involvement in things, I tend to be someone who would prefer limited involvement, but in a situation like this where you can incentivize core industries like semiconductors that are so important to all different facets of the economy, I'm kind of all for, kind of incentivizing those behaviors that you want to see through these types of programs. So, I'm glad that we're investing money into trying to make sure these companies do produce that here domestically. Next up is Henry's article. So nearly half the $4.7 trillion property debt market matures in 2026.
Yeah, so I love this type of layout to kind of show where the bulk of the maturities are coming from, right? Because if you look at it, by asset class type, you can see that hotels are the larger percentage point here. We have industrial, which is the next runner-up, office, and then obviously you see retail, multifamily, which is kind of interesting because it's like, in my opinion, I mean, look, I'm a big retail, multifamily, industrial guy, right? Like those are the main 3 asset classes that I target the most. And if you're looking at this article, you can see that honestly, like I don't see a lot, like in a lot of these situations, and realize this. CMBS loans, right? The 31%, those are huge loans. 99, like those are huge, right? Like the ones that like the stuff that everyday average commercial real estate brokers, I think, are going to be able to get a taste of is the stuff that's under banks, the 25% that's under the banks. I don't think anyone's going to be like people, average real estate brokers are not going to be able to be touching this kind of stuff. I just don't see that becoming a major opportunity for a lot of real estate brokers because these are going to be huge multi-$100 million loans, a lot of the cases, like huge product. I think that the only opportunity, like the main opportunity that we're going to have is to be in touch with some local banks where we can possibly, build some relationships where, they're going to be reaching out or we can reach out to them and figure out what they have for the smaller types of stuff, right? The let's just say industrial, retail, or multifamily, like the stuff between, maybe a few $1,000,000 to maybe 10, 20, 30 million bucks at most. Because even most bank loans, like, and again, most bank loans are really up to like maybe, 5 mil, 10 mil. Like they don't really do the larger loans.
Yeah.
So
especially the regional banks for sure. They have like kind of and they have a concentration threshold that they look at too, where it's like, if we have too much concentration in one property type, we're not going to loan anymore on it. So, there's definitely nuances to small and regional lenders. And I couldn't agree more with you about trying to build relationships with different banks and getting connected with people in those institutions that are responsible for disposition of real estate, because I've gotten pretty decent opportunities in the past from CFOs and other people in different lending institutions. That one was just a prime example. I sold a Walmart outlot here in Louisville, or just south of Louisville, that was a bank repossession, and I was able to get, it was an over $1 million property. And that was all through a relationship I built with a lawyer who happened to be representing this lender, and it just kind of connected, and we ended up making a deal work. So there's so many nodes that you can leverage, and in my opinion, the best relationships you can possibly try to build are legal relationships, lending relationships, and sometimes financial advisors here and there. But I would say that those are the type of relationships long term that are worthwhile to pursue, because they really can be extremely fruitful.
And just keep in mind that, like, look, guys, like, as much as everyone keeps talking about the debt maturities, like they are an inevitability. They are, and it's like, what piece of it are you going to capture, right? What opportunity are you going to be capitalizing on? And realize that, the Blackstones of the world, the huge, private equity companies of the world, they're the ones who's getting the first opportunity. They're number one in line. We're not number one in line.
Next article that we have is related to the federal government may need to slash 5 million square feet in leases under the new budget. So as part of the fiscal year budget for 2025, there's $7.3 trillion, which it just makes me want to gag, unfortunately, that's the budget for what we have to expend. But I digress. A piece of that budget is going to be allocated towards housing agencies within certain real estate, whether that's they own the property themselves and have to deal with the management and operation of the property, or they actually have to sign a lease long term on the building. But based on the way, I guess, some of the leadership in the organization that's focused in this category, they're going to try to reduce their lease footprint by 5 million square feet. So from 173 to 168. And again, this is partly due to the fact that, they just don't need as much of space anymore, based on, I think further down here, it was referencing like the total footprint that they're currently occupying. It was referencing...
Well, it says that, 173 million.
Yeah, no, 173 million was the total square footage, but they were saying that there was like a survey done.
Analyzed 17 agencies, combined 21.5 million square feet of headquarters, found workers were occupying 25% less. Yeah.
Yeah, exactly. So in 17 agencies, total combined square footage in these headquarters are 21.5 million. They found that workers were only occupying 25% or less of that space. So they could even slash even more, to be quite honest with you, unless they reverse their course on requiring people to come into the office. I would say this is probably a continuing trend, and this year maybe they drop by 5 million, and next year they drop by 5 million, but at some point, the trend is going to just continue downward, in my opinion. But I thought I'd get your take on it.
Well, first off, the $7 trillion, let's just call a spade a spade. I mean, this is just ridiculous. Biden, what on planet Earth are you doing? Thank God again, we don't know if he'll even be in office in 2025, so who knows? Not to get political, but like, this is his proposed budget for a year that he may not even be in office. But it honestly, it's kind of crazy to think about, because, and honestly, I'm just curious about this number, right? So I'm just going to Google this real fast. What is the U.S. national tax revenues? The U.S. government has collected $1.86 trillion in 2024. Yeah, 2023, the federal government collected $4.44 trillion in tax from tax revenues. Now, how on planet Earth do you spend $3 trillion more than budgets? Could you
You run a
imagine
deficit,
running a
man.
company?
I mean, we've been spending more money than we have for probably 2 decades since the late 90s. I mean, it has been
Yeah.
a literal and I don't get it. I'm in your boat. I'm like, how long can you continue to spend to this degree when you don't have the amount of
Well,
revenue coming in?
apparently the answer is more than 20 years because we've been doing it for more than 20 years, right? So,
Yeah.
which is just absolutely ridiculous. I mean, I
Yeah.
don't even understand that. I can't comprehend it. I think it's absolutely asinine, and I don't know how that makes any sense. How the government leading by example of get into credit card debt or get into credit debt. That's number one. Number two, yeah, I mean, I don't even, if you actually look at it, the government actually owns the most real estate in the world. Or in the country, they own the most real estate. They also occupy the most real estate, as you can tell, as a single tenant here, which is just ridiculous to think about because it says federal tenancies are 173 million square feet, right? 173 million square feet occupied, and they're saying that they only occupy 25% or less. We could be slashing half the buildings and be perfectly fine, more than half the buildings and be perfectly fine, or half the square footage and be perfectly fine. It makes absolutely no sense to be in this type of, because think about it, I can't even imagine. I mean, who knows if they actually own all these buildings, but I can't even imagine what the cost savings would be. It even says here at the bottom, the GAO found that federal agencies spend $2 billion a year to operate the federal office buildings and an additional $5 billion a year on commercial real estate leases. What's crazy is that $5 billion a year in regards to the $7.4 trillion is nothing. What is that? That's not even 10% of 1%. That's not 1/10 of 1%. That is less. It is almost a 0.5%. What is it? A half of 1/10 of 1% of the budget goes to leases that they're absolutely just blowing money on. That means absolutely nothing. You know what this tells me? I need to buy some federal government buildings because clearly they got money to blow and it doesn't matter. I
don't know if you've read this book from Peebles Principles. Peebles out of Washington D.C. He's a big developer over there, but he's
Don Peebles,
he's buying up a bunch of these buildings, and in his biography or his book he talks about like how he was kind of got in that way, and I mean it's fascinating, man. It's unbelievable.
I mean, look, it says the proposed budget will also accelerate the GSA's previously announced plan to sell 23 federally owned buildings, including the Nebraska Avenue complex, and then a bunch of others. But there you go. We could be like Don, and we could start buying some these federal buildings. But I'm guessing they're not going to be occupying them anymore.
No, they won't be. But maybe you could do an adaptive reuse, and maybe they'll incentivize you. And give it to you at a really good rate.
Seller financing at 0% interest.
Yeah, I mean we're borrowing money at ungodly rates. So
why just slide it over to me. That'd be nice.
Yeah, exactly. All right. So next up, the bumpy road to calming inflation.
Yeah. So this is just the continuation. Yeah. If you go in this image here. I love the images. I like to be able to look and kind of get a gauge about. Yeah, it really helps a lot. So this is just showing the consumer price index versus the core price index, and it shows here based on for inflationary percentage rates where we are. Again, I believe this is it's the change from the previous month. What's interesting to me is that I don't see one time that it's a negative.
Well, I guess in July of 22, it looks like it maybe ticked down to a fraction of a percent.
That almost looks like an even. It almost looks like the same.
Yeah.
It's like I don't see a negative. So I don't see on planet Earth, this doesn't make any sense to me. The fact that we've only seen an increase, which I don't even think is accurate. I mean, because the consumer price index, yeah, obviously, this is just to show that, well, I mean, every year after year, that obviously there's not going to be much of a decrease. But the point is that this is basically trying to show that inflation has been going up nonstop. At let's see the percentage numbers here. The consumer price index is No, you're fine. I'm just calculating the numbers. I'm going over with the blue bars. We're averaging at 0.5% a year. Is that where we're at right now?
I think it was
our previous month.
This is quarter. This is quarterly.
Month.
Oh, it's monthly. Okay, sorry. Yeah, you're right.
Yeah. Change from previous month. Yeah. So this is actually quite interesting to show that we're going up almost 0.5% a month, which is 6% a year. And we have been doing that consistently. I mean, obviously throughout 2022, I mean, we were probably, I don't even know, 8 or 9% total for the year, something like that. And maybe even 10% for the year in 2022. And then in 2023, we started to get to about an average roughly somewhere between 4 and 6%, and we've been around the same since. This is very interesting stuff. We're we've cooled down a lot, but I really like this. The wherewithal of trying to basically curve inflation. Whatever they're doing hasn't worked. Even though, look, Barry, I think we talked about this. Barry Sternlight had talked about how, or I forgot who I spoke to about this, but Barry Sterling was talking about how if you look back, because inflation is 12 months behind, we've basically been under the threshold for the rental index, because the rental side of the housing is so much more. It's like 40 or 60% of the overall inflation numbers. And it's what's crazy is that like 12 months ago or 6 or 12 months ago, however far back it is, they were saying that it was under where we need to be. It was under 2% of where we needed to be. And we have yet to see any single freaking proof of that, which is, I don't understand. I don't understand how anybody affords anything. It doesn't make any sense anymore. It makes no sense. Everybody I talk to is having problems. Again, I'm talking about average, everyday, middle-class American. America is struggling drastically. So I don't understand how this is still a problem.
Yeah, I don't either. I mean, it's, I think, again, there's so many moving pieces at play, and we've talked about it plenty of times. The Fed always looks back and they try to make determinations on what the future is based on old data, which is typically 3 to 6 months, sometimes 12 months if you talk about the housing reports or the rental reports. So I think they're always slow to react and they're always slow to respond in certain scenarios. So is it surprising to me that they're not going to do anything in the meantime? Like, no, it sucks, because even with the job numbers that, they're reporting, we've talked about it many times. Like, I'd love to see what those job numbers entail. And again, I'll be completely candid. I have not looked at the job reports to that granularity. So I can't comment if these jobs are like really high paying jobs or whatever else, but I would almost bet you that the jobs that they're reporting are like jobs like part-time work here and there. You may have to have 3 jobs in order for you to even break even when it comes to all the expenses, especially what's been affecting from inflation. So the Fed doesn't take that into consideration. It seems like it's very surface level when they look at these types of numbers. So anyways.
Yeah, look, I'm not expecting them to make any drastic adjustments today, but the fact of I just am shocked that they think that they can keep this up and America can keep it up. Here you go. Wages grow faster than the inflation for almost a year. I mean, this just goes to show the numbers are incredibly. You scroll down just a little bit more so you can see the red and blue line. Yeah,
I'm sorry.
No, the average hourly earnings versus consumer price index. So it's like, the average hourly earnings, like how much money you're making on an hourly basis has been going up on average around 4%, 4 and change percent a year. And the consumer price index has been right behind it. So it's like your dollars are not even going any farther. You're barely keeping up with inflation just on a dollar per hour basis. And
you're still trying to catch up. They're still trying to catch up from all this inflation that occurred just, through 22, 21, 2022. So,
and it's like most people, again, the dollar per hour, I mean, like the dollar per hour index here, 4%. It's like most people aren't even getting 4% raises a year.
I mean, I know plenty of people that stay at the same job and they barely get any wage increase. And obviously, another thing is that it puts a lot of strain on employers too. So at a certain point, there's something's got to give, because, as an employer, if I'm hiring someone that I have to pay 15 to 20% more than I would a year ago, there has to be a commiserate amount of increase in revenue. Otherwise, my margins get shot, and then it's not really worth it for me to continue.
I agree 100%. And trust me, as an entrepreneur with many employees, I think that it really is a struggle to figure out this interesting middle ground where you can continuously hire people, where you're also getting hurt on the idea of how much more you have to pay them to even keep them. So it's it's just trying to find this win-win scenario, which is really hard these days to figure out, which is why a lot of people are going to VAs, because, you can pay a VA a fraction of what you're paying a full-time employee for almost the same work. Even if you get a third of the workload and you're paying them a tenth of the amount of money, who cares?
Or you switch them to straight up commission and say, look, you eat what you kill. And that's kind of where we're at. So, the expectation is somewhat similar there, but you talk economics all day long. All right. So next up is making the numbers work for build to rent. Just to kind of clarify what build to rent means. And, for those of you guys who are watching, build to rent communities have been around for a long time, but they've really gained a lot of traction in recent years. Essentially what happens is there's developers that will buy large swaths of land and then build residential communities to then rent out to just average everyday people. It's a little bit different of a model than people buying property and building multifamily properties. It's less density. You can't pay as much for the land, but it can be a unique proposition for landowners, because usually the build to rent community developers are going to be able to pay more than the standard home developers. Those are usually the entities that pay the least for land on an acre basis. So it's kind of a happy middle ground. But I guess this particular article highlights the reason why build to rent communities have continued to become so popular, and then explain the differences between build to rent communities and some of the multifamily developments that have occurred over time. The big thing that is what makes or breaks these types of communities. Is the land cost is number one. So they have to get it under contract and purchased at a reasonable price. Granted, they're going to be able to pay more than the home builders, but they can't pay as much as a multifamily community developer because they just don't have the same amount of density. And then on the construction, on the layout side, they have to make sure they can maximize what they can with the footprint. So typically, you'll see these build-to-rent communities have at least 50 single family rental homes. Sometimes you'll see it come into the 100, 150 range, like a true large residential development, like you see a lot of these people take on. And then, they talk about the industry and how it's trending upward. Apparently, there's 100,000 additional units that are planned or under construction based on some metrics that they're tracking. The areas for growth that they are targeting are, obviously various different core markets and major gateway cities like Los Angeles, Boston, Nashville, Charlotte, Atlanta, etc. But then the Midwest is an area where there's been sizable rent growth from a single family home perspective, and that's where a lot of build-to-rent developers are starting to look at. I know in our brokerage we've worked with a couple different build-to-rent developers to try to find sites for them in our local market because the numbers just tend to make sense a lot better. So there's a lot more of that push happening, at least in our market. And I'm sure in markets surrounding us, like Indianapolis, Cincinnati, Minneapolis, etc. So thought I'd kind of share this insight with you all.
The traditional thought process is, when you have dirt and you're trying to sell it to a home builder, they need to be at less or about 10% of future value, right? So if the entirety of the sellout is $10 million, you need to be into the dirt for about $1 million. With the build to rent, you typically have the ability to go as high as like 15%, right? If you're going to, a multifamily apartment buildings, you can get to like 18%. You start squeezing these margins, right? But when you're trying to, this is why it's important to understand the dynamics as an investor, being a real estate agent, where if you have like just as good of an eye for value when you're working with these different types of clientele, and like, based on the valuation that this individual wants for their land, I can plug and play these types of investors. I think it's important to know like that off the top of your head, like when you're speaking to someone, like, okay, well, you can get how many units? Okay, 100. Cool. Based on 100, what do you think the rental value is? Cool. And then you back out a number and you're like, okay, well, based on future values, these are the 3 types of offers that you can get, right? This is going to be the range of offers in which you're going to get. And that is basically holds true for most areas across the country, just about. So, obviously in certain areas, it's a little bit higher, a little bit lower, but it's really important to be paying attention to like, hey, why don't you call up one of these home builders, get an idea of exactly what they're looking for. These are huge home builders. They literally show up. The coolest part about these types of people is that it's all public. It's all public information. You can literally Google build-to-rent home builder, right? You can see exactly where they're building. You can see exactly what communities they built, right? It's all public information. It's on their websites. You can literally see all these. And then you can call them up and say like, hey, I see you just bought a community here in the Midwest Carolinas or Ohio in the Redwood section, but it's all there. And you can literally just call them up and say like, hey, I saw that you bought this property it's all public information, what they bought it for. You go CoStar Reonomy, corrects you, whatever. You find out what they bought it for. Say how many how many units did you put on there? Oh, you put this many units. Okay, great. So if I can find you another property that's around the same size, would you pay around the same price? And then you could literally just prospect for them right around the same area, right? The game is the same, but it's just finding these types of buyers. It's all public information. Instead of just reading the article and say, hey, that was a great article, reach out to them, get some information, figure out if, where near you that they are, and go find them some damn property.
And understand those opportunities, because if you find a piece of property and you get it under a contract at an attractive price because you know what developers are looking at and the numbers they're going to run in their head on the back of napkin math, you create a unique opportunity for yourself potentially to buy the property and flip it, or you may be able to get another person to buy it, like you said, to prospect around an area. So there's a lot of value.
It really is. It is that simplistic, right? Like if you want to make $1 million and you say they bought the neighboring property for $5 million, 2 acres, I'm making something up, guys. They bought 10 acres for $5 million, right? They bought 500,000 an acre. If you go find another property with 10 acres locally, right, and you lock it up for $4 million, you can make $1 million. It is that simplistic. And boo-hoo, if you only make 2% or 3% or 5% or 6%, you're still making hundreds of thousands of dollars pretty simply.
All right. So next up is, here's one hint big investors are looking to buy, betting on lower rents. Or lower rates, I'm sorry.
Yeah. So if you scroll down just a little bit, this is just talking about all the REITs right now and how much money is sitting on the sidelines. You can see from Blackstone to all these different REITs are literally just sitting, waiting for great deals to be coming by. So what the reason why I wanted to say bring this up, and you can scroll down. I think there was a couple pieces here that like it's focused on industrial. You can see like again the industrial net lease sales fell $6.8 billion last year, approaching $17 billion in sales in 2022, which is crazy to think about. Sales fell to $6.8 billion in 2023, which is crazy. And you can see that industrial properties made up 22% of net lease sales in 2019. That number grew to 37% last year. So obviously there's a major increase in that. There's just so much money sitting on the sidelines, guys. There's billions and billions and billions of dollars sitting on the sidelines waiting for great deals to be found. And if you find great deals, you will sell them. Getting on the phone, finding the money. There's like endless REITs here that talk about the amount of money they have sitting on the pipe on the sideline. All these huge transactions. Look at these deals that are happening. Mm-hmm. The REIT has already assembled a portfolio of 6 industrial properties for a purchase of $142 million. In January, Fortinus Net Lease REIT acquired a 212,000 square foot industrial building in Parkersburg, Pennsylvania for $28.8 billion. They just bought industrial building. This is a major leaseback. That's what this was structured at. We talked about leasebacks last week. Hey, this property was subsequently leased back from the seller of Victory Brewing Company under a 25 net year lease agreement. You find a huge organization that has a 200,000 square foot building that they are currently occupying. You structure a net lease. You call up Fortress. And that's it. It's not that complicated. They obviously are buying in Parkersburg, Pennsylvania. Pick up the phone, find another property. There's at least another 100 or 200 of these types of opportunities in every market. You just got to find it, right? Think about it, $21.8 million. If you would have found that deal and you made a measly 2% commission, you're talking about $400,000. And I guarantee you, this was done by a broker. And that $800,000, that 21.8, that $800,000 was 4% commission that was paid out to 2 brokers. 4% commission. They found a guy who wanted $21 million. They got Fortress to pay 21.8, and they made 4%. They made $800,000 on the deal. That's how simplistic this game is.
Absolutely, man. Yeah, and like you said, I mean, it kind of reinforces the fact, and we say this every week. I mean, we've had articles talk about the dry powder that's available. There is opportunity out there. You guys need to be able to continue to hustle and make sure that you can get in front of as many people as possible to be able to structure some of these deals. So, obviously, I appreciate the feedback there.
I hate seeing them, and I'm like, why was I not a part of it?
Why was I not a part of it? Of course.
That's how I think about it. Every deal in the state of New Jersey. It's every deal in the state of Florida. I'm like, why was I not there? What did we miss?
All right, so next up is CoStar Economist delivers both good and bad news for industrial real estate. So I guess one of the things that they did describe was that, economic growth was obviously still pretty strong considering what we're feeling in the economy and the people. I mean, obviously, Henry and I were talking offline that, we've been talking to people and we just can't believe that, we're not considered in a recession, even though I do think that we're somewhat there already. But again, it's just we still see these numbers being in a positive direction, yet it's not manifesting with positive sentiment. But overall, what they're describing is that the economy seems to be doing decently well. We've added jobs, which obviously benefits from a spending perspective, and industrial real estate is dependent on products and services being exchanged in the economy because you need places to store, especially product wise. You need places to be able to store these products. So logistics real estate will probably benefit. The biggest issue that we're facing is interest rate environment is very tumultuous right now. With rates being so high, transaction volume in industrial real estate has fallen off significantly, and we're starting to see record number of deliveries in the marketplace come available. So I think here at some point, so here it is. Supply responded to strong demand. Cooper said in 2021, 307 million square feet were delivered, followed by 395 in 2022. In 2023, we saw 534 million square feet delivered. That's almost 33% higher than the year before. So you're starting to see record number of buildings starting to come online, and with demand likely beginning to cool for a variety of different factors. Because another thing that they mentioned in this article is that one of the big drivers for demand for space is transactions in the home market, because whenever people move, they're having to buy new furniture, they're having to buy, different things for their home. And that's a big piece of the economy on the retail side. So, industrial demand is obviously a big piece of industrial demand is driven by consumer and home goods. So with that dropping off significantly over the last year, they're kind of predicting that there may be some issues going forward. But
overall, look, I love this part right here. Developers are more focused on big bucks distribution projects, and 90% of what's being delivered is 100,000 square feet or more. Cooper said that around 400 million square feet of space is currently under construction is unleased, in addition to around another 400 square feet or 400,000 square feet remains unleased in 2023. I mean, I don't know if it's a typo, 400 million square feet of space is currently under construction, is unleased. And then there's another 400,000. I think they probably meant another 400 million square feet. That doesn't make any sense.
Most likely, yeah.
That's it. Because in addition to around another 400 million square feet that remains unleased in 2023. That's about accurate. So there is just so much freaking supply. There is so much supply, right, that is being created, and it's in the massive quantities. A crazy amount of space is being built. Like in northern New Jersey, it's one of the most densely populated areas in the country. And we have so much industrial property in that area, and there's so much being built and so much that has been built that it's hard to keep up with demand. I mean, so you just have a lot of these huge buildings that are vacant, several 100,000 square feet all over the place in New Jersey that are vacant. And it's funny, like if you think that you're going to be like the people who keep developing it in South Jersey, they're going to be vacant for quite some time because all the demand is near Manhattan.
Yeah.
Right. So it's interesting where I see this all the time in Jersey. All the time.
It was the wave of spec development is where you had a lot of these large developers that were like, hey, we'll build this thing and we're going to get it leased up before we even get done. And so now,
or so they thought.
Or so they thought. And that's why I'm not I would get super nervous about spec building.
I think spec building is smart, but not massive projects where you could do a couple 100,000 feet in a community, but do it as flex space and do small bay flex space. As long as you're close to big hubs, I think you're going to do fine. Like the 2,000 to 10,000 or the 1,000 to 20,000 square feet flex spaces, I think are in very high demand.
Oh yeah, they are. And obviously with the spec build piece, like building something that is flexible like that, where you have the ability to be able to modify if need be. So maybe one day, Henry, you'll take on a project like that. That'd be pretty cool to see.
That's right. So, it's coming. I
mean,
I'm selling one right now, funny enough, but
nice.
On the broker side, not buying it.
For this particular article, it is why is it not all doom and gloom for commercial real estate? Premise of this particular article is they kind of start off with describing what people have been feeling in regarding the commercial real estate landscape for some time. So they talk about how in Japan, Switzerland, other parts of the world, they've had to write off a lot of bad debts. Obviously, the New York Community Bancorp situation where they essentially had to get there's an investor group that came in and had to backstop with over $1 billion in cash to kind of quell the concerns that the economy had. In all that's kind of doom and gloom, you're starting to see, not even starting to see, I guess, the performance of commercial mortgage-backed securities compared to other investment vehicles like corporate bonds, treasuries, and other types of loans, I guess, have performed well. So compared to those three types of investment vehicles, CMBS have actually performed better, which is somewhat surprising considering that you have a lot of people that are spewing doom and gloom in the economy. And this lady, Tracy Chen, I don't remember exactly what capacity she has. I don't know what her role is, but she was kind of explaining kind of the reasoning for it. I guess the CMBS market's a lot more transparent than some of these other markets for these different securities. And as a result, the doom and gloom was already kind of priced in to the CMBS market. So as we started to go through this process, there's been improved sentiment pertaining to this particular asset. And so she envisions that because of this, that we're probably getting close to getting through the worst of it, at least on the CMBS side. And she did say that on the CMBS sides, it seems like that's going to be a much more prevalent way of financing projects in the near term. So, again, just kind of reinforcing based on what she's seeing, there is likely going to be some improvement, at least in the CMBS side. You can't really comment on regional banks and their ability to loan depending on their exposure in the commercial real estate space, but at least in the CMBS side, she's optimistic. So that's kind of the comment.
I mean, this also just kind of dives into a lot of, mostly about the fact of, the regulations changing in regards to like office buildings. I think things are just getting tighter, right? I think banks are getting wiser. I think people are getting less risk adverse, more risk adverse, not taking as much risk with a lot of properties these days, while interest rates are as high as they are, right? You're seeing that property banks are right now underwriting office space, even Class A office space, at a 1.5 to 1.75% debt service coverage ratio, which is just ridiculous to think about. But obviously, who the heck would want to invest in an office building right now? It just doesn't make any sense. If you're thinking logically, why would you want to be investing in something like newspapers, where you have a declining market faster than things are growing, right? Or year after year, you see it declining, right? The values are declining that fast, where it's like you could allocate the same exact amount of money into things like apartment buildings, which also have pretty steady growth over time, or things like a retail steady growth over time, industrial steady growth over time. And these types of things where of course the banks should be highly regulated. Of course we should be tightening restrictions when it comes to looking at loan, what debt service coverage ratios. Of course, we should be tightening these restrictions for different asset classes that absolutely have the highest likelihood of defaulting. Why would you not do that? If it was your money, you would do the exact same thing. I am not surprised by any of this. I think that also I'm surprised it actually took them this long to do it, right? And by the way, I'll call it here. I guarantee you, when interest rates drop, when they do, whenever it takes, however long it takes, under 5%, we're in the 4s. Maybe we'll touch 3s. I doubt it. If we ever get to 4s again, I guarantee you banks will start being stupid again.
Well, it's you got to get the money out. It doesn't do them any service by sitting on their books. Like it's a liability. Deposits, and this is something that's kind of fascinating. Deposits from a bank perspective is a liability. So they need to get that money circulating in order for it to become an asset for them. So if you kind of have that perspective, you start realizing like banks don't want to necessarily hold the money. Like they're just doing it right now because of the way that, the economy's shifting, but they're typically inclined to loan out money because it's how they make their assets, which are their liabilities, which are deposits.
You even hear this sometimes though, where like they're asking for so much money in deposits that's almost like you're funding your own loan.
Yeah, it's funny. I mean, it's like, oh, we'll do this deal, but you got to move all your business over here, have XYZ.
Yeah, you have to have $1 million in checking account balances average for the course of the year, and you're going to put $1.5 million down. It's like, okay, so I'm just financing
the down
my
payment.
own loan.
Yeah,
exactly.
Oh, I know. Sense. Yeah, I mean, and the deals I've been working right now, especially on the investment side, I mean, again, higher down payments. Like I did one deal 2 weeks ago, 40% down. I did another deal that we didn't even go through a bank. We just paid cash for it. Well, the group did that I dealt with. Now we're dealing with another pretty large shopping center here that we're making a play at, and it's going to be in that 40% range as far as down payment's concerned. So it's like very capital intensive to get some of these deals done. If you don't have the money to work with, it's hard. And that's why, it's so important to have the capital available, because I think that's when you can really capitalize on some opportunities. But all right, so Dollar General says it's on track to open roughly 800 stores this year. Wow.
Dollar General says it's on track to open roughly 800 stores this year. Expansion plans come a day after rival Dollar Tree says it'll close 1,000 Family Dollar locations. Is that ridiculous? So it's going to it's so interesting to me that Dollar General is doing so well. I'm so curious what the heck the difference is. I don't even know the last time I was in a Dollar General, to be honest with you. Right? Or even a Dollar Tree. It's over 10 years ago. I honestly couldn't tell you the last time I was in one. But I just think it's insane that the discount retail behemoth Dollar General heralded the arrival of its 28,000th store. And touted plans to open up another 800 stores this year. Just a day after its direct competitor said it's closing roughly 1,000 brick and mortar retail locations. Ridiculous to create. It's a freaking nuts thing to think about. Dollar General, based in Tennessee, reiterated its plans Thursday to execute 2,385 real estate projects in the fiscal year of 2024, including the opening of 800 locations, remodeling 1,500 locations, and relocating 85 stores. The retailer hit the 20,000 store mark late last month and celebrated the grand opening of the X location. The firm, the 20,000th location. The firm is expanding its capital spending from $1.3 to $1.4 billion this year. And obviously, things like Dollar Tree is going to shut down 1,000 stores. Wow. It's like, what are they doing differently? I'm very, very surprised because, I'm actually working a couple of clients that are working on Dollar Trees. I'm very curious if maybe, we try to switch them up and we try to make them work. But I found that I guess Dollar Trees and Family Dollars, at least from what I've seen, and maybe you guys can tell me tell me in the comment section what you guys are experiencing, because I'm very curious what you see. My experience is that Family Dollars and Dollar Trees are in strip centers, and Dollar Generals are standalone triple net buildings. And I'm very curious to get your thoughts on that. Do you think that is one of the major differences? Because I do believe that I've rarely seen Dollar Trees or Family Dollars that are just by themselves, where the Dollar Generals are very small. They're much smaller. Like if you scroll up real quick, I'm guessing here, but something like maybe 80 to 100 feet in the front, and then maybe 40, 60 feet on the sides. Okay, it's these types of locations are only maybe 10, 20,000 feet. If that is the case, maybe 10,000 feet here, maybe that's the secret. Because a lot of these buildings, the huge Family Dollars, the Dollar Trees, I feel like they were substantially larger. But I'm curious to get your thoughts, like what you think that is.
With Family Dollar and Dollar Tree in particular, they're typically located in urban areas, like densely urban areas. So you'll see them in, just neighborhoods. Whereas Dollar Generals, they just locate in the middle of nowhere. Obviously there are some in urban areas, don't get me wrong, but it's not uncommon to see a small community that has 1,500 or 2,000 people that live there, that all of a sudden a Dollar General decides to locate right around that corner, and it becomes kind of the general store for that community. And that's where they've had a lot of success. And the gentleman who started Dollar General. His dad was he ran a convenience store, that same concept, a general store in that location in I can't Goddessville, I believe it's called. He wrote a biography, and I remember reading it, and it was kind of fascinating. The whole premise is like they're trying to appeal to the everyday person. Like they can walk in, you could buy like, you know, different items that you would need around the house, and you can get it at a reasonable price. And so that appeals a lot to people who tend to live in suburban markets or areas that, you know, don't have as many options. And that's where they're kind of cutting their teeth and having their bread and butter, really. I would think that's probably their model is a little bit different. I would imagine Dollar Tree and Family Dollar have been trying to kind of follow that model recently because they've obviously had issues with the way they've approached it in the past. So kind of my thought.
If you scroll down here, it says the Dollar Tree, they have a lot of common. Facing similar problems in the with theft and shoppers pulling back on discretionary spending. Last year, let's see, Dollar General and Dollar Tree ranked as number 1 and number 2 in the U.S. store openings. Because last year, Dollar General opened 987 stores, remodeled 2,000, and relocated to 129 stores. This year, store openings will include 30 pop shelf format locations and 15 in Mexico. It's just very interesting, these types of things where, like, you know, you have, you know, several different business models where, like, essentially they're almost identical, right? Family Dollar, Dollar Tree, Dollar General, and they all do the same exact thing. And one company is absolutely crushing it, and the other two are a little bit wonky, right? It's like the CVS, Walgreens, Rite Aid. It's like, you know, CVS has been around for quite some time. You know, I think they're the ones that are doing the best. They're the one buying everybody else, right? I think that's the way it is. And Walgreens and Rite Aid are struggling.
Yeah, and you're starting to see like Dollar Trees and some of these other potential tenants backfill some of the spaces. We've had a couple locally that had like Walgreens in them, and all of a sudden now Dollar Trees operating on site. So,
yep,
you know, they're subleasing their space to these entities. So,
no, it's smart. Anyways, we appreciate you guys for tuning in. Thank you as always, and we'll see you guys next week. Take care, everybody. Thank you.